But in the background is a much more powerful group, and that is the politicians. The politicians are the ones that actually set policy. When the politicians decide that economic growth has gone too far, they will change the game. And I believe that.
Hey guys, welcome back to Library of Wealth. Today we have macro investor and crypto bull Raoul outlining why the market could be the last opportunity for investors to generate gains during this period of rising inflation and crashing stocks. Powell takes us through how to navigate the crypto and stock market during this volatile cycle, his investment thesis, and his financial outlook for the coming months. Now, even though we're in a recessionary climate, Raoul says that we haven't seen the worst of it. He believes that the current trajectory we're seeing now is only a precursor for what's to come. The Federal Reserve uses money printing to stimulate the economy, but that growth is short-lived as the inflation rate gets higher and higher. You won't see the effects right away, but it's a time of investor panic when they see red across the board in the market. Let's get into the interview with Raoul as he lets us know what to expect in the crypto, stock, and bond markets up until the end of the year. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
What I'm worried about is what is currently breaking. And people say, what's going to break? What's going to break? My view is that in a massively indebted world, to put this in perspective, the US is some 300 and something percent of GDP in debt, as total debts to GDP. It is 100% of world GDP in debt. It's the most indebted any nation has ever been. And everybody borrows dollars. And we're in a system where they're trying to act like Paul Volcker, because basically the Fed is run by a bunch of baby boomers and they want to get a book out where they're on the front cover like Paul Volcker to be the heroes. But I think what they're doing is fighting the ghosts of the past. The ghost of the past, the 1970s, was wildly different. We've talked about this in Daily Briefing before. The demographic setup is different. Also, the debt is different. I mean, the US is like 100% of GDP in debt, total debts at that point. We're now at least another 150%, maybe 200% of GDP in debt on top. So with an aging demographic and high debt, it's very difficult to generate inflation. But the Fed are now convinced they need to be Paul Volcker, and they are going to go and raise rates further than the market can deal with. And we're seeing it. We're seeing it everywhere, that the market's going, we cannot deal with rates like this and the liquidity that's happened. So liquidity has been drawn out by quantitative tightening. What they've done with the banks and what bank reserves have to be held has kept money out of the market. There's basically no buyer of the bond market. So there's a few charts. I think Claire's going to try and share them. Bond market liquidity is basically as bad as it was in the peak of the pandemic, when the bond market froze and everyone was worried Citadel had gone under, whoever had gone under. That's how bad the bond market is now. It is completely decoupling.
Because wages haven't gone up in the last 50 to 60 years, but inflation and prices have, millennials can't get ahead. Powell explains how the devaluation of currency has not only led to globalization, but the Fed's protection of money didn't lead to an increase in wealth. We've never had inflation of this kind without recessionary measures. It's up to the Fed to bring it under control and navigate the economic, global, and geopolitical situations effectively.
So if I sum them to one thing, the Fed have not yet realized, and nor have most market participants, that real rates have to be negative forever. And that's the only way of getting rid of the debt. That is financial repression 101. And it's not just being driven by the Fed, the markets are doing that because of the rate of return. So if real rates are negative, which was the 1940s and 50s too, because they had massive debts after the war, the outcome is actually higher asset prices. And I know people can't stand that, but that's what it is. I think people are projecting what they want, not what is. What is the Fed have got break-even rates of inflation down to the twos, and if this continues for the next few weeks in the vein that it is, and if oil continues to trade towards $60, which I've been saying it's going, these break-even rates are going to come down to 1%. So the battle is won. Now, I actually think, and I've said this before on the show, I think actually inflation is negative in 18 months' time. I think they completely misread the bullwhip. And the bullwhip was post-pandemic, spikes the inflation because everyone comes in the workforce, no supply, overreact to the supply. Yes, they should have raised rates, but not like this. They've misread it. They want to be Volcker, and before they know it, they've destroyed the economy and inflation as well, and they've got their old friend back, deflation. So this is not a fear of inflation, really, because the Fed are saying we're going to do anything to kill inflation. Well, what's happened is the break-evens rate has agreed with that and said, yes, inflation is not the enemy. And break-even inflation, I'm looking at the 5 years, is at 2.4%, which broke down today. And 1 year is at 1.95. So they're basically around 2%. So the market's saying forward-looking inflation is back to normal. Okay, but the problem is if bond yields are going up and inflation expectations are going down, you see this next chart, Claire, which is real rates. Real rates have been trending lower over time. This is 5-year real rates. They trend lower because of debt and demographics. So you need to have low real rates to stimulate the economy or run it normally. So the trend rate of real rates is actually negative 1%. But we've just seen the fastest ever rise in real rates in history. So you're raising real rates on people at a time when they can't afford to service their debts because there's too much debt out there. So it's creating chaos in the bond market because the Fed have essentially gone too far with this whole mechanism between how the banks can use their balance sheets, plus quantitative tightening, plus raising the Fed funds rate. And the market's freaking out. So it's decoupled from the fundamentals as well. So the bond market, Claire, if you bring up the next one, which is the ISM and the bond market are tied at the hip normally. Basically, bond yields go down when economic growth is falling because growth and inflation fall. And that's right. What's happened is bonds are pricing an ISM now in the 60s, high 60s, when the ISM in the next month is going to cross 50. So the ISM is going to be pointing to recession, which we all know is happening from almost every single guest we've had on. Yet the bond market is broken. So it's saying the opposite. Now, we've seen a few episodes similar, but this is the furthest it's ever been from the business cycle in bond market history. I am long crypto, so I've luckily added significantly pretty much at the low, so lower than here in ETH and Solana around here, and some other bits and pieces. And I own some technology stocks, which I bought down 75%. A whole basket, bunch of different ETFs, doing the whole exponential age from gaming to metaverse to AI to robotics to genetic sciences to EV, all of these mega big picture themes. So I just bought a very broad basket there, which is a long-term bet, which again, if it sells off any further, and it hasn't made new lows for a long time now, since June, I would add into that.
And your time horizon is longer, right? When you're talking about
the time horizon is longer. I was actually talking to somebody today about what would I do in the short-term time horizon. I actually don't know. It's pretty hard. I might sell some oil, but it's really volatile and scary. I don't really. I'd probably sell some more currency for a bit, versus the dollar, because I think the dollar goes higher. But those are matters of 2-week trades. I would be really nervous to be in any way in most of these kind of trades for longer than 2 or 3 weeks, because I feel like we're getting very close to the tipping point if this continues.
Powell says that anytime he's gone outside of Bitcoin and Ethereum, he's always carried a small, equally weighted basket of assets because he never knows what's going to succeed and what will fail. He also says that domestic bonds and emerging markets will almost never default because they print their own currency. He states that what has happened to Terra Luna was comparable to the Argentina crisis because the payments came, but they had no value. Raoul Pal says that nobody has a right to network adoption or risk, but you must avoid hubris. People become overconfident, but they've actually made a big mistake. What do you guys think about Raoul Pal's take on the current state of the financial market? Let us know in the comments below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.